Friday's close wasn't the end of the silver move. It was the setup, because in financial markets, what matters most IS&T where a price trades during the day, it is where it opens next. Silver crossing $67 during trading hours already activated stress inside the system. But an open above $67 on Monday would do something very different. It would force markets, banks, and clearinghouses to accept that the move is no longer temporary. It's no longer volatility. It's reality. Over the weekend, nothing trades, but everything recalculates. Risk models reset, margin systems update, losses that were once unrealized stop being flexible and start becoming enforceable. By the time markets open on Monday, decisions have already been made by machines, not people. That's why Monday opens are dangerous. They remove hope. They eliminate the assumption that prices will revert, and they force institutions to act immediately with no room to delay, hedge, or negotiate. If silver opens above $67, the system doesn't ask whether the move is justified. It doesn't care about sentiment, narratives, or news. It only enforces rules. Collateral requirements rise, risk limits tighten, and institutions arrive at the market already under pressure. This is how financial stress actually begins, not with crashes or headlines, but with quiet enforcement at the open, when everyone realizes at the same time that positions must be adjusted. Liquidity must be found, and exposure must be reduced immediately. The question isn't whether silver will go higher or lower during the day. The real question is what breaks when the market opens and there is no way back below the line. Because once an open confirms a level, the system stops watching prices and starts demanding compliance. And that's where the next wave of systemic stress can begin. When markets open on Monday, they dare to start fresh. They continue from a position of judgment. The opening price is not just a number on a screen. It's a confirmation. It tells every risk system in the world whether the market rejected a move or accepted it. Intraday spikes can be ignored, faded, or dismissed as volatility. But an open above $67 tells the system something far more dangerous. This level is no longer temporary. Risk models inside banks and funds are built around assumptions. One of the most important is mean reversion, the belief that extreme moves pull back quickly. A Monday opened above $67 breaks that assumption instantly. It forces models to reclassify silver exposure from volatile but manageable to structurally At that point, flexibility disappears. Margin systems don't negotiate. They reset at the open. Losses that could be carried on Friday as unrealized suddenly become recognized. Collateral that was optional becomes mandatory. Institutions don't get time to adjust during the day. They arrive already behind, already required to post more capital, already facing tighter limits. This is why weekend gaps are feared more than fast rallies. There's no chance to hedge overnight, no chance to roll positions quietly. When silver opens above $67, every leveraged position is evaluated simultaneously, using the same rules at the same moment. And that synchronization is dangerous. The market might look calm in the first minutes of trading, but beneath the surface, pressure is building. Banks and funds aren't reacting to price action, they're reacting to enforcement. Capital is being redirected, exposure is being reduced, liquidity is being pulled inward. Once the open confirms the level, the system stops asking whether silver should be here. It only asks one question: who can survive here? And that's when the real stress begins. Once the market closes, most people assume nothing is happening. But that's when the most important work begins. Overnight, silver isn't trading. It's being judged. Clearinghouses, prime brokers, and internal risk engines begin repricing exposure using the new reality. The price isn't treated as noise anymore. It's treated as a condition. Losses that were once marked as temporary are reclassified. Stress scenarios are updated. Value at risk models expand. What was acceptable risk on Friday becomes unacceptable risk by Monday morning. And this happens automatically, without headlines, without debate, and without human intervention. This overnight repricing is brutal because it removes options. Positions that depended on rolling forward, on calm liquidity, or on short-term pullbacks suddenly don't qualify anymore. Margin requirements increase before markets even open. Collateral calls are prepared in advance. Some institutions discover they're already out of compliance before the first trade prints. And here's the dangerous part. Everyone is repriced at the same time. There's no staggered adjustment, no gradual pressure release. The entire system wakes up to the same new constraints. That synchronization turns individual losses into systemic stress. By the time markets open, the damage isn't coming, it's already embedded. Institutions don't react to the opening price emotionally. They react procedurally, capital is shifted, risk is cut, liquidity is preserved. Not because panic has started, but because survival protocols have been activated. This is why markets can look stable on the surface while stress intensifies underneath. The repricing happens in silence. The consequences appear later. Silver opening above $67 doesn't shock the system. It hardens it, and once risk hardens, the room to maneuver disappears. Once risk has been repriced and positions are tightened, the next problem appears immediately. Liquidity, not assets, not valuations. Cash available right now. When silver opens above $67, the demand for liquidity doesn't rise gradually. It spikes all at once. Every institution facing higher margin requirements needs cash simultaneously. Collateral must be posted, buffers must be rebuilt, and unlike assets on a balance sheet, liquidity cannot be created instantly. It can only be borrowed, sold for, or withdrawn from somewhere else in the system. This is where pressure accelerates. Selling assets quickly doesn't raise clean liquidity, it creates losses. Borrowing becomes expensive because lenders see the same stress signals and pull back. Even high-quality collateral starts to lose effectiveness as haircuts widen and confidence tightens. The most dangerous part is that liquidity shortages feed on themselves. The more institutions try to secure cash, the more scarce it becomes. Prices gap, spreads widen. What looked like a manageable adjustment turns into a scramble. And this is not driven by fear. It's driven by mechanics. Systems are enforcing requirements that don't care about intent or long-term strategy. They care about compliance in real time. Markets can still trade. Charts can still look orderly. But beneath that surface, capital is being trapped. Liquidity is being hoarded. Interbank trust starts to thin. Not because anyone has failed yet, but because no one wants to be last in line. This is the phase where stress stops being isolated. One institution's need for liquidity becomes another institution's problem. Pressure moves sideways through the system, not vertically through prices. Silver opening above $67 doesn't cause a liquidity crisis by itself. It synchronizes one, and once liquidity stress becomes synchronized, the margin for error disappears very quickly. As liquidity tightens, attention shifts to the one constraint markets can't negotiate with: physical reality. Silver isn't just a paper asset. Behind every futures contract, every derivative, and every leveraged position sits an assumption about availability, and when prices open above $67, that assumption comes under pressure at higher prices. Delivery risk stops being theoretical. Contracts that were expected to roll forward quietly start carrying the possibility of settlement. Physical silver that was assumed to be accessible becomes scarce. Premiums rise not because of speculation, but because supply can't adjust at the speed of financial demand. This is where paper and physical markets begin to separate. Futures prices might suggest liquidity, but real metal tells a different story. Dealers widen spreads, delivery timelines stretch. Inventories that look sufficient on paper suddenly feel tight. For short positions, this is the most dangerous phase. Losses are no longer just marked. They carry the risk of performance. Forced buying begins, not as a strategy, but as an obligation. And forced buying at higher prices feeds directly back into the market. Each move higher increases stress on those still holding exposure. Each attempt to exit pushes prices further. The feedback loop tightens, not because demand explodes, but because exit routes shrink. Silver doesn't need panic to become unstable. It only needs constraints. Limited supply, rising obligations, and synchronized enforcement are enough. Opening above $67 intensifies all three. And once physical pressure enters the equation, control becomes illusionary. At this point, many assume that banks or central institutions will step in and restore order. That assumption is comforting, but it's flawed. Financial authorities can influence markets, but they can't suspend obligations. And when silver opens above $67, the problem isn't volatility, it's enforcement. Banks don't fail because they run out of assets. They fail because they run out of usable liquidity. And liquidity only exists when confidence exists. Once institutions begin questioning whether counterparties can meet obligations, lending tightens immediately. Cash stays where it is. Risk is pulled inward. Central banks face a narrow window. Acting too aggressively sends a signal that something is wrong. Acting too slowly allows stress to compound. Even emergency facilities don't solve settlement problems, they only delay recognition. And delay doesn't remove pressure. It concentrates it. Markets can pause trading. They can't pause settlement. Clearinghouses don't wait for policy statements. They enforce rules in real time. Collateral must be posted. Exposure must be reduced. Positions must comply. This is why interventions often arrive after damage has already been done. By the time support is visible, liquidity has already tightened, confidence has already thinned, and institutions have already shifted into defense. What looks like calm is often restraint. What looks like control is often containment. And containment only works while confidence holds. Opening above $67 doesn't overwhelm the system instantly. It narrows the margin for response. And when that margin disappears, even powerful institutions are forced to react instead of led. While most people focus on charts and price targets, experienced capital watches something very different. They know that by the time headlines appear, the opportunity to act has already passed. What matters now are the signals that don't make noise. The first is margin behavior. Sudden changes in requirements reveal stress before price reacts. These adjustments don't make news, but they force behavior. The second is clearinghouse communication. Subtle updates, procedural language, and tightened terms often appear before any visible disruption. The third is physical market behavior. Rising premiums, delayed delivery, and shrinking availability expose constraints that futures prices can't hide. Liquidity usage is another quiet signal. When institutions begin leaning heavily on funding facilities, it's not confidence, it's necessity. And necessity spreads quickly. Smart money doesn't wait for confirmation. It reduces exposure while exits still exists. It prioritizes survival over return. This isn't panic. It's preparation. The goal isn't to predict headlines. It's to avoid being trapped by them. The absence of drama is often the loudest warning. When markets appear calm while systems quietly tighten, history shows that pressure is building somewhere unseen. Silver opening above $67 doesn't announce a crisis. It reveals whether one is already forming. Silver crossing $67 was never about momentum or speculation. It was about enforcement. An open above that level forces recognition, not opinion. It turns flexibility into obligation and probability into certainty. By the time most people react, the system has already adjusted. Liquidity has already moved. Risk has already been contained or concentrated. The loud phase comes later when options are fewer and exits are narrower. The real lesson is simple. Financial systems don't break when prices rise. They break when obligations collide with constraints. $67 is not a forecast. It's a line of confirmation. And once that line is accepted at the open, the system stops asking questions and starts demanding answers. In the next video, we'll examine what happens if silver holds above $67, not just for a day, but for an entire week, and why that S-where forced liquidation risk stops being theoretical and becomes unavoidable. Silver opening above $67 is not a headline moment. It's a confirmation moment. It tells the system that this level is no longer a test. It's a condition that must be dealt with. At that point, markets stop debating direction and start enforcing reality. Risk models harden, margin requirements rise, liquidity pulls inward, and institutions are forced to act not because they want to, but because they must. Most people will only notice when the noise begins, when volatility spikes, when banks make statements, when headlines start asking what went wrong. But by then, the most important decisions have already been made quietly, inside systems that don't explain themselves. This is how financial stress always unfolds. First, silence, then pressure, then speed. The real danger isn't the price of silver, it's what that price forces behind the scenes, obligations becoming unavoidable, liquidity becoming scarce, and confidence thinning all at once. $67 isn't a prediction, it's a line of enforcement. And once that line is accepted at the open, the system doesn't slow down to let anyone adjust. It moves forward mechanically until balance is restored. or something breaks. If you want to stay ahead, don't watch the excitement. Watch the constraints. Because the most dangerous moments in financial history never announce themselves. They happen quietly.